This is Chapter 1, Capital Budgeting, Chapter 21, Capital Budgeting and Cost Analysis, Part 1. Okay, this chapter is one of those where all of the heavy stuff is in just a couple of these learning objectives. So first, we got another 5 stages of capital budgeting, but then use and evaluate 2 main discounted cash flow methods, the net present value method and internal rate of return. Okay, so we'll do, I'm going to get through these 2 in this presentation, and then I'll do the rest of them in the rest of these in the next presentation. Okay, so the thing of it is, these are discounted cash flow methods, and then discounted payback, that's just cash, there's no time value of money in it. And then we'll also look at the accrual accounting rate of return, which is in every single textbook, but I've never seen it used, well, it was never used in my day at work. Maybe it's used now, but I mean, it has a specific purpose, but I've never seen it. So what is capital budgeting and why must it be undertaken? And working closely with accountants, top executives figure out how and when to best allocate financial resources among alternative opportunities to create future value for the company. Okay, that's really the objective, and because it's hard to know what the future holds and how much projects will ultimately cost, this can be really challenging, but it's something that managers constantly confront. And the other thing that you may not appreciate is that if you went forward with an idea for your company, something that you wanted to promote, you wouldn't be the only one. You'd be competing with people from all over the organization that want to spend capital dollars. So all companies need a standardized way to review these proposals, and a bunch of criteria that they use to evaluate which ones they think they're going to do. And the financials play a really big part in this, but there's also a lot of qualitative information that is important. Now, capital budgeting, the process of making long-term planning decisions for investments in projects. Okay, long-term. So we're looking at long-term financing, at bond financing, or possibly equity financing. Okay, these are complex projects, and as we calculate income on a period-by-period basis, and when we choose investments, managers make a selection from multiple projects, many of which span several periods. Okay, several years, could be 20 years, could be a very long time. Now, we've got 2 different intersecting dimensions of capital budgeting cost analysis. Horizontally across is the project dimension, and that's as different events take place in the project, and then vertically upward is the accounting period dimension. And to make capital budgeting decisions, managers analyze each project by considering all the lifespan cash flows from its initial investment through its termination. Okay, so many times when we've done work like this before, like a make or buy decision, or to offer a special price to a company, we're really looking at just a single period. All right, now these are multi-period decisions, so we look at it over at least a 5-year period. And this is a nice illustration. This is the relationship between the 2 dimensions, and you can see the time period that they go over. Okay, and maybe this is where we are right now. I don't know, but it's sort of a Gantt chart. Okay, so it represents the dimensions of income determination and routine annual planning and control that cut across all projects going on this year. So say for 2018, we would be in this spot amid all those projects. Now, managers use capital budgeting as a decision-making and control tool. Like the 5-step decision process that's in every single chapter, there are 5 stages to capital budgeting. And here are the first 3. So you identify the project, get information, you make predictions, then you see how it turns out, and you compare that to what your plan is. And I think that the reason why they only put 3 in here is because nobody ever does the last 2 steps. If you can sell management on this, I actually used to be in charge of a process like this, and we never did any review of what actually happened. It's a little embarrassing. Oh, here's the rest. Make decisions by choosing between alternatives. We did this. And then implement it. Okay, we implemented it and then we stopped. We never evaluated performance and learn, which is really important. Okay, learning is emphasized a lot more in companies now. Obtain funding, all right, is a big piece of this, and tracking realized cash flows. Now, how are you going to do this? All right, unless the money from this project is coded in a system, you can't track it to within all the rest of the income and expenses that you have for the year. And that's probably why we didn't track it, because it wasn't coded. So it's really important when you design accounting information systems that you accommodate things like this. Okay? Yeah. Now, new projects often require additional investments in current assets, such as inventories and receivables. And if you are going to have an increase in inventory, that's just like a cash outflow. All right? That's how to consider it, because it decreases working capital. And working capital in this chapter refers to the difference between current assets and current liabilities. And any additional investment required for a project would be included in that project's cash flows. So we show everything as it relates to cash. Okay, cash coming in, cash going out. Depreciation isn't really cash, but we might look at the tax effects of depreciation. So we've got 4 capital budgeting analysis methods that you need to know. Okay, the first is net present value, then internal rate of return, and these 2 are the discounted cash flow methods. Okay, and then the payback period and accrual accounting rate of return. So we'll look at each method in more detail, but first you want to be able to distinguish these discounted cash flows from the other ones. The thing of it is people use them. These are the closest to what the numbers are really going to be. But what payback tells you is it tells you how long this project's going to stretch out before it starts before it pays for itself. So the longer it takes to pay for itself, the riskier the project is, because things change in the meantime. So that's what payback tells you, and it's a short, easy number to get, easy to understand, so managers like it. If you've got a project that is costs $150,000 and it returns $50,000 a year, it's going to pay for itself in 3 years. Okay, it's short and easy. You don't even need a calculator. So, and you can compare it quickly to other projects. Now, the accrual accounting rate of return shows you what effect the project will have, like on the financial statements. Okay, on the income statement, what kind of an impact will it have there? So that's a value tool. Now, discounted cash flow methods, they measure all expected future cash inflows and outflows of a project, discounted back to the present point in time. Okay, T sub 0, right to today. And the key feature is the time value of money, which means that $1 today is worth more than $1 in the future. All right, and the reason is that $1 today could be invested in, say, at 10% a year, so it would grow to $1.10 at the end of the year. All right, so that would be one way to look at it. Now, the time value of money is the opportunity cost from not having money today. All right, it's like the second best option of what you could do with money. And discounted cash flow methods use the required rate of return, which is the minimum acceptable annual rate of return on an investment. Now, make sure that you pay attention to that when it comes up, because I don't know, it kind of goes over your head really fast, and then you get a problem and you don't know what they're really talking about. And if the minimum acceptable annual rate of return refers to how much the shareholders want to earn on the investment. Okay, so if the shareholders want the company to earn 15%, then a project would have to earn 15% to be acceptable. Okay? So the minimum acceptable annual rate of return on an investment. All right? And that rate of return is internally set, usually by upper management, and it usually represents the return that an organization could expect to receive elsewhere for an investment of comparable risk. All right? And it's also called the discount rate, the hurdle rate, cost of capital, opportunity cost of capital. It's all about interest. So net present, now we're going to go through these methods, and if I were you, what I would do is like go through net present value, I'll tell you when, and then stop the presentation and do one of the problems that comes along with this, or just go through it just so that you've got a more of a hands-on approach, because this is another chapter where you want to do a lot of problems to make sure that you really understand the concepts. So net present value calculates the expected monetary gain or loss from a project by discounting all expected future cash inflows and outflows back to the present point in time using the required rate of return. Okay, that's our cost of capital. You know, and this is a tough number, especially like if you're valuing companies or doing any work like that. This is a difficult number. So based on financial factors alone, only projects with a 0 or a positive net present value would be acceptable. All right? If it's less than 0, then it would not be acceptable because it wouldn't have earned what we wanted it to earn. And we'll use 3 steps for net present value. So draw a sketch of the cash inflows. Okay, let's see at the next slide here. There we go. Well, this is really hard to see. Let's say, this is a little better, sorry. Draw a sketch means here is the activity that happened. Okay, there's my additional investment. That's a cash outflow that happens at time 0. Okay, this is 0, 1, 2, 3, 4, 5. So there's a cash outflow, and then we start earning money. And the project earns $180,000. It earns $180,000 each year, okay. But we're going to discount it back to today's dollars. So if I spend $548,900 today and get cash inflows of $180,000 for the next 5 years, the net present value of my project is $69,840. Okay. And what they've got here is since the Wilton will do this in the problems, but since all the cash flows are the same, you know, exactly 180,000, we can use an annuity table and discount it using the present value of an annuity, which would be, you know, a payment at the same amount every year. Okay, so this is what they mean by a schedule. So you've got the activity, like what's happening down here with cash going in and out, and then the discounts going across the top. The other thing that's kind of handy is a summary of what the assumptions are up at the top. So you're going to draw a sketch, discount the cash flows using the correct compound interest table from Appendix A, and what we'll use are cash flow tables. Some of you might want to use your calculators. I like tables probably just because I'm used to them and because it helps me catch mistakes. I know I've got a better reasonableness idea than I do with a calculator. If I put it into a calculator, I don't know what's going to come out. And then make the project decision. Whoops. Make the project decision on the basis of the calculated net present value. So 0 or positive would be accepted because the expected rate of return equals or exceeds the required rate of return. Okay, so here's our chart again. This is exactly how we'll do it for our problems. And the next one we're going to do is internal rate of return. So you could stop here right now and just do one short net present value problem. Okay, internal rate of return method. And what this does, this sets two sides of the equation equal to each other, and you solve for the discount rate. So the internal rate of return method calculates the discount rate at which an investment's present value of all expected cash inflows equals the present value of its outflows. So we set the inflows equal to the outflows and then figure out what discount rate will do that. Then we take the, like we might get like 0.54623 out of it, something like that. Then we'll go to, or maybe 1.54623. Then we'll go to the annuity tables and look that number up, and that will tell us what the rate of return is, okay, the actual percentage that it's earning. Okay? And if a project is accepted, only if the internal rate of return equals or exceeds the firm's required rate of return. Managers or analysts solving capital budgeting problems typically use a calculator or a program, but I always thought a more manual trial and error approach can also provide the answer for net present value. You're not going to have to interpolate or anything like that. Our problems will work out nice and even. So, you know, you'll after you do a few, you'll get the hang of it. Okay, so this is an example of using the internal rate of return. Well, this is actually more of a proof of it than anything else. Or if you had a computer program that did it for you, it could generate this. But the point is that there's our cash outflow, the $648,000, and that is equal to the inflow of cash over the next 5 years. So the net present value would be 0. Now what we did was we discounted these cash flows at 12%. Okay, that's what it had to make. So it's discounted at 12. So that is the internal rate of return on this project is 12%. That's what it does. Let's go back to the other one. This was discounted at 8%. Okay, that's the firm's cost of funds. That's what it is, 8%. Okay? So this one again is 12%. We're almost done. So this is probably a good time to stop and do an internal rate of return problem while some of this stuff might sort of be in your head. Okay? Now when you compare these two methods, net present value is generally preferred because its use leads to shareholder value maximization. For a lot of reasons. The net present value measures the capital, captures the value in today's dollars of the surplus the project generates for the firm's shareholders over and above the required rate of return. And it can always be computed for a project because it's expressed in dollars. It can be summed to calculate an NPV of a combination or a portfolio of projects. And the net present value method can be used when the rate of return varies over the life of the project. Okay? So there are a lot of good things about NPV over IRR, and there are some weaknesses of this. The internal rate of return assumes that money is reinvested at that rate of returns, at that rate, okay? And that is, that's a faulty assumption. So if the IRR, internal rate of return, is less than the required rate of return, okay, the internal rate of return is less than the required rate of return, then net present value would be negative, okay, which would mean you would reject it. Obviously, managers prefer projects with higher internal rate of returns to those with lower. Okay, now here's an example. If a company has a required rate of return of 12%, and the internal rate of return of a project is 12%, it means that the cash inflows are adequate to cover the initial investment in the project and to earn a return of exactly 12% on the project tied up in the project over its useful life. Okay. I think we need to look at some. The internal rate of return is more prone than net present value to indicate erroneous decisions. See, and this is what I mentioned before, the IRR implicitly assumes the project cash flows can be reinvested at the project's rate of return, not necessarily. So it's slightly overstated. And net present value accurately assumes that project cash flows can only be reinvested at the company's required rate of return. Okay, which is a little bit more conservative. Still, IRR is widely used because because managers find it easier to understand the net present value, and that is just a fact. That's just the way they are. We do all these forecasts for action plans in the strategy course, the MBA program, and the MPV, which to me is really straightforward, but it just blows their socks off. They have a hard time. It's a big deal to do it. So if you ever end up in there, you'll look really impressive. And then finally, we do sensitivity analyses. To present the basics of NPV and IRR, we assume that the expected values will occur for certain. And to manage uncertainties, you can do some what-if techniques. You can vary the inputs to the calculation by a certain percentage and then see what the effect is on the NPV, just to know how much room you have to move in it. Okay, if your assumptions change, interest rates change, or the length of a project change, or any of the inputs do. Okay.